Did you fall for the trap? Because I won't lie, it was a pretty impressive rally on Thursday, but it didn't really do much to actually change the calculus of the current state of the market. Now, I'd love to be proven wrong, but I just don't see it yet. So welcome back to the Trade Brigade Weekend Show, where we'll take a look through all of the data points and we'll build a logical trade plan. My name is Matt, and if you're new here, hit the thumbs up button and subscribe. For additional resources, check out the links listed down below in the description, and stay tuned until the end of today's show. I've got 12 additional trade ideas to share with you that you won't want to miss. With that said, let's jump right into the charts. So we'll kick things off with a closer look at the SPY monthly timescale. Now that the March bars have officially closed out, I just want to provide a little bit of an update versus the conversation we had last Saturday, now that we are left with this lower wick as it relates to monthly structure. The lower wick certainly looks bullish, and I would still acknowledge the fact that we have lows, higher lows, higher lows, higher lows, and this is very well potentially a monthly higher low in the trend count, pulling back from the highest high. So the trend remains up, but I do just want to talk about timing here as it relates to 610. 610 would have been a beautiful capitulatory style level to potentially buy if we continued the rubber band effect, right? The rubber band effect is just sort of that prices extend, get really stretched into that level. That would have been a great buying opportunity if we could have actually seen capitulation, so extended downside even further on an increase in volume. I would have been sort of looking to buy that with some decent conviction, right? But we did not actually make it to 610, the left side peak. So what I want to talk about on the monthly is more of a timing issue. If we do see the market revisit 610, it's still absolutely a key area of potential monthly support, but I also want to talk about the ability to overshoot that level. Notice that when we get protracted downtrends on the monthly timescale, and really you just have to look no further than 2022, you can print these lower wicks, you can bounce a little bit in the upward direction, but if you revisit that, you're probably going to overshoot with a little bit more magnitude, right? So 610 can be overshot, and it wouldn't ruin the monthly higher low thesis for me. That's the update I really want to bring based on the updated structure of the lower wick not actually making it to that key level. And again, let me be clear, 610 is still an important number to watch and monitor for, but the overshoot level that may actually become more of a watch, and I'm not saying we have to get there like this immediate next month, but the unfilled gap on the weekly timescale, let's actually just get down there now and take a look. So monthly trend still remains up. I want to end maybe on that note as it relates to the monthly. As we drop down to the weekly, this is that unfilled gap I was just mentioning. It's way down here at about 570 to 575. Once again, I'm not talking about going here next week, the week after, even maybe the week after that. It's just a downside reference point that I do think could be in play if we end up overshooting this 610. And I wanted to update the analysis based on the lower wick, right? That's the main point of revisiting that structure. Great. Now let's take the weekly chart as we typically do. What do we actually see here as it relates to candle structure, location, and the overall trend? Of course, candle structure is actually pretty bullish last week, right? We could clearly see a hammer-esque style bar where sellers attempt to make a new low. You could certainly pair it with candle location bar to bar. We actually made a lower low, but buyers step up there in a meaningful way, pushing prices back up to the opening print, but they don't stop there. Of course, range expansion in the upward direction, closing in the upper third of the weekly range. So structurally, it's a great bullish bar, right? It indicates a failure from the sellers to move lower, and then a strong close also back over the weekly 50 SMA and back in the upper third of even the previous week's range. So nice progress in the upward direction, but it doesn't actually do anything to change the weekly trend is kind of where the sort of enthusiasm runs out, if you will. Now, I'll give a little bit of credit where credit is due. The 653 area did not act as picture perfect resistance, but I still think we're within striking distance of that, either acting as the lower high on the weekly and getting something that looks like this, or as we know, I mean, there's still plenty of room for the market on the weekly timescale, right? Which means that intra-week we would have uptrends to trade to get there. So like, I know everybody's starting to get all bullish once again, and oh my God, the market's got to go back to all-time highs. Like, I totally see the sentiment shift online. I get it, but let's be honest with ourselves about this chart, right? Is there not still the threat for a lower high here underneath major weekly overhead supply, underneath the weekly 20 SMA? If we were to get there, I would certainly be respectful of 675. That's the same level we've been talking about for quite some time now. And we also know not only is it just the weekly 20 SMA, but let me go ahead and do a couple things here. Let me start with perhaps the Fibonacci pull from the all-time high to this most local low. It's the Fib 61.8, which as we know is always the line in the sand. As long as we're below that, you really haven't done anything to substantially change the tone as it relates to that. And also, you know, yes, the overshoot on the recovery back above, in this case, 653 down here, but where are we relative to the Fib 38.2? we're right on it. So in sort of one sense, this is also still just setting up for the potential of bear flag consolidation down here. All it's going to require is an early week turnaround, which honestly, based on the labor data that was released at 8:30 this morning, Friday, the broad markets, or I should say the cash markets closed, futures were technically open. The response was not really that great. And we'll get into it, of course, as today's episode wears on. But any sort of consolidation down here is just bear flag consolidation on the weekly. So that's that. And also, in terms of confluence around that 675 area, let's throw on the anchored view app stack. I mean, that's entirely where the top bundle is. If the market rallies into that, again, like you could trade longs to get there. Please don't misunderstand what I'm saying. But I would certainly respect it as a potential area for a lower high to keep the weekly trend down. So what would it, and also, I mean, let's not forget the most obvious one, which is just the amount of volume that exists above us here. Take a look at it, right? Look at all the volume, the overhead supply, the volume profile does an excellent job of actually illustrating that. Let's go back in here with this, and let's talk about what it would take for me to actually want to change my tone on the weekly timescale. Two ways that this could happen. Either the V-shaped reversal is so sharp and we smash a weekly close back over 675 area. Great. Guess what? I can't really argue with the recapture of all those key reference points that we just acknowledged at that level. That's bullish. Maybe we make an equal high and then we start looking for a higher low. The other situation is just that we do get the lower high threat up against this area, right? We start looking like this, we pull back, and then we set some kind of a higher low. If we start looking like this, and who knows, maybe it is actually going to be roughly at these prior low sets over here at 653. If we can establish a weekly higher low that's worth risking against, and I could do something like this, risk reward wise, back up to the all-time high, if not ballooning runners for follow through. And at this point, I'm not talking about a day trade here on that risk reward area. I'm talking more about like longer term positioning against a weekly low. If that's the case, then great. I'll take that attempt because it's a tight risk opportunity and there's clearly some indication of a trend reversal. Of course, we would get more bullish on this situation if we could Brigade bolt over whatever the neckline ends up being. I'm just sort of using the picture perfect outcome via the actual structure here. But wherever the neckline is, maybe it's a little bit lower, maybe it's a little bit higher. That would also, start to make me change my tone on the weekly trend. So as a trend follower, I will never be able to nail the exact low of the move, but I will have a much more confident approach to the market, knowing where my risk is, right? If you were just buying this here, where were you going to put your stop? Unless you had already sort of said, okay, I'm going to put my stop here, let's say. Okay, fine. I guess you could still use some left side references, but why would you be stopping out into the monthly higher low thesis at 610, right? So different sort of strategies for different folks, but as a trend follower, as someone who's looking for that confident stage to reverse the market back in the upward direction, this would get me a little bit more bullish. And I mean, history sort of aligns with this outlook anyhow. If you just look back and do the work, I mean, go do the homework. It's not that hard to do. We'll do some of it right now together. Take a look at what happened in 2022, where we did actually have that protracted bear, right? The weekly downtrend was pretty deceiving, right? You made a set of lows, you rallied actually to set a slightly higher high, dare I even say, in that upper wick, but where's the weekly higher low? You never actually had any compelling weekly bar in here that suggested, yeah, here's the weekly higher low, let's make the turn, let's make a move back to all-time highs. We did not have that situation, never mind any sort of break over a neckline, right? The first weekly higher low actually started to step up over here, right? Maybe you could have argued for this after testing the weekly 200, but this really was it on the weekly higher low. You actually start to get some hammer indications. And then really, I'd say like one of the better breakout buys was this shelf right here, right? The market had been making a series of higher lows, equal highs at that point. That breakout, pretty compelling, right? So if you're just studying trends as of right now, once again, just to sort of summarize it in one word or one sentence, one phrase, this is still a counter trend rally in the context of a trend that is now down. And it doesn't get much better on the daily time scale, right? So let's move there now. Let's get a little bit more granular here. And let's see what's going on. So weekly expected move is up first. What do we see as it relates to this gray shaded box? If you're not familiar, by the way, check out the video tutorial in the top right hand corner on how to set this up. The upper bound is about 672.49. I've got to give the buyer some credit there. That's certainly a higher high above the daily 200 SMA, as well as this previous inflection point. It just so happens that the 200 is confluence with this area right now, but this inflection point, the previous area of support that did act as resistance, we would be breaching that if we hit and tag the upper edge of the expected move. The lower bound of the expected move is down here at 639.17, implying a slightly higher low, but we'd just be back down underneath that weekly inflection at 653, which doesn't really make me feel all that bullish, even if this does suggest a very mild higher low. Like, I would not look at that and say, oh my God, like this is it, that's the end, right? So not at all. The expected move, therefore, strikes me as being somewhat neutral into the coming weeks worth of trade, where, especially in this box, it's almost segmented in perfect thirds, where this is definitely neutral. Bears definitely have more of the edge if we make the move back down underneath 653. And I would say buyers have some attempt to sustain up here over the 200 if we could spend more time over that 662.50. Now, keep in mind, right, the worst time to potentially get bullish in a downtrend is as you're making a lower high rally attempt, right? So right into here, I would not be like a breakout buyer attempting to, get long up against 675, the daily 50, which is barreling down on price. We could get there this week. It would start making me feel a little bit more bullish in terms of where price is trading, but it doesn't necessarily mean that I'm putting risk on at the highest high of the counter trend attempt, right? That just doesn't make sense as it relates to risk reward. Now, let's clear this up and let's just sort of snap back to reality for a second and say, okay, Thursday's rally attempt, let's start talking about this in a little bit more detail. Like, did you fall for the trap? The title of today's video. Thursday's rally attempt was pretty substantial, but does it actually do anything to change the trend here on the daily? I think the answer is no. I mean, if I'm counting trend, I've got highs, I've got lower highs, I've got lower highs, lower highs, lower highs, lower highs. This is still potentially a lower high. And we talked about it on Tuesday, but the easiest way to also talk about it is just, are we under or above all of the key moving averages? We're still below the 20, we're below the 200, we're well below the 50 SMA. Just like not fully on board the idea that, Thursday is the unlock and, oh my God, we're going all-time highs. Now, do I have to give a little bit of credit? Of course. On a gap down like that, I would have expected much more of either just sideways consolidation that then leaked lower into the end of the week, or if we did rally, which of course we did rally, some kind of a gap fill reversal up against the low of the Wednesday session and that big weekly level at 653. You got your overshoot, you're sort of rejecting near the 20. Let's see if we can go gap fill reversal as of Thursday's session. That didn't really happen. So I've got to give the buyers a little bit of credit there on the Thursday session, but it doesn't do enough, in my view, to actively make me change my stance and say, okay, here we go. All-time highs are going to be here in the blink of an eye. Now, if we do want to concede a bullish data point here, let's talk about follow-through day, right? And we talked a little bit about this on Tuesday, but we'll bring it up one more time. Why not? If we're going to get an active follow-through day, then what we need out of the market is a 1.5% update as measured from the previous day's close. Everything on my watch list is measured from the opening print. So please make sure you're using updated numbers if you want to take the true IBD approach. It's 1.5% from previous day's close, let's say PDC. And then also what we want to see is an increase in volume versus the prior day, so an uptick in volume. And this needs to happen on day 4 or beyond of the rally attempt. So 4 or beyond from the rally attempt. So the low was set here. That's your low session. You can't really take that low out. Otherwise, you reset the count. This is rally attempt day 1. This is rally attempt day 2. This is rally attempt day 3. And once again, as we talked about on Tuesday, Monday could be the first day, the first session where we actually get the potential for a follow-through day. If the criteria is met, it would be another bullish data point that I add into the narrative, but it wouldn't. Let's just quickly check, actually, by the way. Let's just do this math. Let's come in here, and where is 1.5%? Up here, right? So right at the tip of that red line is 1.5%. If we were to do that on an uptick in volume, fine. That's, again, it would be a reclaim of some pretty substantial levels as it relates to the 200 SMA, the 20 SMA, this prior area of support, which then acted as resistance, as we've already covered. If we even rally and close above that, again, am I just buying blindly the close the follow-through day? No, absolutely not. But, it would start to be, once again, another data point in the narrative to potentially change my tone from being more bearish to more neutral even, or possibly even looking for higher lows after that. So that's the bullish concession on the daily. But for now, my main takeaway here would just kind of be, if we're noodling around in here and lose 653, I mean, you're just talking about bearish breakdown again, in my view. This is a lower high in the daily trend. We really start targeting at least this pullback low, the gap level from Friday of 2 weeks ago now, if not equal lows beyond that. Of course, would I keep an open mind for the potential of some kind of inverted head and shoulders if a higher low could form in here and then we get a follow through day? It doesn't have to be Monday. It just has to be 4 or beyond in the actual rally attempt count in terms of days. It could happen on Tuesday, Wednesday, Thursday, like any time next week, we could have a potential follow follow through day. If it happens out of an inverted head and shoulders pattern, I mean, naturally, just kind of your neckline would be right in here at that key inflection point. Anyways, if you like horizontals, which I prefer, it'd still be that 662.50 spot. So that's what I've got for you on the daily analysis. As of right now, the trend is still down. To me, this is a counter trend rally in the context of a developed downtrend still. We're underneath all key moving averages. I am conceding a slightly more impressive day there on the Thursday session versus what it could have been. Gap fill reversal, just a weak sort of consolidation and break lower. It didn't really happen. So, trying to give buyers where credit is due. Let's take a look at the hourly chart. You could see right here, right? Boom, markets move up. And that, of course, happened with a combination, the conversation about Iran and Oman working to negotiate sort of how the Strait of Hormuz is going to open back up certainly helped that. But from there, we really just balanced out sideways into the afternoon. And honestly, if I just go look at the futures really quickly, because they were open today on the sort of morning session, at least for the 8:30 labor report, I mean, you saw a flash in the pan to the upside and then immediately retraced the move. So I would tend to think that there's actually more risk that anybody who went out long here is going to be sorely disappointed on Monday morning, or really Sunday night futures open, if we get anything that looks like this underneath roughly 65.92, which, just going back on over to the Spider's cash, is this level here anyhow at 653. So, and we'll talk more about the labor fundamentals in just a second, but the numbers beat expectations, which means that rates basically remain elevated higher for longer. If we drop that, right, on the prospect that rates aren't coming down, oil, of course, is continuing to remain elevated, the inflation risk has been increased, right? Then this kind of situation doesn't really seem all that unreasonable. And once again, this just starts to look like what? A lower high in the daily trend count. And hopefully nobody fell for the trap there. Just bought, and again, like, if you bought the Wednesday gap up open, you got paid a little bit. You suffered through like 125 basis points of downtrend and adverse effect against you for about a 25 basis point gain into the close of Thursday, shortened holiday week, right? So, I wouldn't really be jumping for joy if you were a buyer of this session here. Your risk reward is like completely upside down. So we'll see if we actually go out to new highs. I think there's going to be plenty of opportunities to, first of all, better manage risk if there is going to be a full-blown turnaround. But again, I'm just not seeing it in the data points, which we'll continue to get into. I've sort of talked about some higher time frame stuff already. Let's drop in the intraday anchored view apps. You could sort of see how a couple of the meaningful ones are still barreling down on price. These are all the gap down anchored view apps from here. Anybody who was like, oh, we're going to buy the dip and go to the moon, buy the dip and go to the moon, those people are still underwater as of, Thursday's close. So if this is just going to turn into a great spot to sell the market to get out for break even, that would still make decent sense for me, in my view, to qualify as daily lower high, weekly lower high. People unload there. And then what's the next step? I mean, you just drop these anchored view apps. So the green one is the dotted line from when the Iranian president said, hey, we're ready to make negotiations. This was the ceasefire announcement from Trump administration on the white dotted line, right? If you start to drop this stuff into early stages next week under 653, I just don't really think you have much in the way of saying like, okay, here we go, everything's bullish and its coast is clear. That's not the situation if we're back down underneath 653. Let's clear this up. Let me just remove some of those. That way we could take a look at the Fibonacci as it relates to this counter trend, right? We'll do two fib pulls from the major low up to this high. Fib 38.2 is still technically underneath us, meaning that could this technically qualify as bull flag support off the low? Maybe. Let's clear that one up. Let's take a move from the low of the Tuesday session up to the high. And I think this is a little bit more compelling, right? So certainly the tradable range from Tuesday up to the high of what was really Wednesday. This to me is sort of better confluence and tells the story better of if we hold 653, okay, a little bit more neutral, right? Fine. Buyers trying to do a decent job. If we start to fail that, you're under the Fib 38.2, kiss goodbye bull flag consolidation. I would look to the 61.8, 100% retracement into this thin structure breakout when the intraday announcement took shape. And then, any consolidation that's below, you're really just looking at the equal lows as of last week, right? So that's your fib as it relates to the hourly. Once again, I do have to give some credit to the buyers. If we had stronger sellers, why were they unable to materialize on this gap down? Why could we not go gap fill reversal? So once again, 653 early week is going to act as the line in the sand. Neutralizing bias a little bit, not a lot, a little bit. If we're above, definitely back to the bear side. If we're back below, thin structure retracement, first target 642.85 and beyond. That's it. If it's going to be bullish and we consolidate up here, maybe I would be interested in trading some counter trend longs, taking this shelf out at 662.50. Talked about that level in quite a bit of detail on the daily chart. Risk reward through that range, something along these lines. It's worth a shot. I would also be incredibly open-minded. I can't underscore this one enough. I'd be incredibly open-minded to potential look above and fail. right? Something that looks like this, market tries to break out in that segment of the line, completely fails and sets a lower high back underneath. Yeah, I'm just inverting that risk reward entirely, risk and then reward back down to the downside. And I'm trading that as a lower high on the daily time scale. Very, very open-minded to that, probably even more open-minded to that, look above and fail on the daily 200 than I would be in terms of going with any potential move in the upward direction based on supporting evidence. So speaking of supporting evidence, let's start to get into some of that stuff. Let's go out to the full internals dashboard. If you're not familiar with the market internals, check out the video tutorial in the top right-hand corner. What did we actually see on Friday? I'm going to say Friday, so just apologies in advance for the number of times I'm going to say Friday. On Thursday, volume inflows through this big rally back, not impressive. No trend higher zone, no move up and over 300 million. Even on that sort of Wednesday gap up, I got my day correct that time, we had neutral and flat-ish volume flows there. So I'm not really convinced that like, oh my God, everybody's going out there and buying this with both hands. It kind of looks more to me like a short squeeze, right? Honestly, this is way more short squeeze indication than anything else. If you take a look at the advanced decline line, same thing. It's like this was not in trend higher zone here. We did not make it there on that Thursday session. I will give credit intraday, the index score. Of course, that's an intraday gauge. This measures from the opening print. Impressive, and rightfully so. The market moves straight in the upward direction. I would hope it wasn't reading in the downward direction, otherwise something's broken. Look at your cumulative tick. I mean, are you kidding me? That's horrible. And remember that this doesn't measure from the previous day's close. It measures every 3 seconds, tick by tick data across the NYSE. That's a terrible looking cumulative build there into the close on Friday, all things considered, after this squeeze in the upward direction. So at the exchange level, does this really look like new money buyers are sitting on the bid waiting to get filled? And, here we go. It's a nice controlled uptrend and buyers are really getting involved in outlaying, major capital? Absolutely not. This like looks way more like short squeeze to me than anything else. And honestly, our next data point over here, going on over to the market profile, sort of suggests the same. These are short-term traders who are kind of, dare I use the word, in control of the market. It seems like oil is in control of the market. The media narratives are in control of the market. But, buyers and sellers, we try to be as honest as we can about, buyers and sellers move the auction. The auction is the market, right? I think this is impressive, right? First of all, this is a P-shaped profile, so you get yourself short squeeze from that indication. But take a look at these single prints. I mean, the market dipped a toe into those singles, could not close them all the way, and then, rallied hard out of them on Thursday morning. So that to me, like if we had stronger sellers, then these singles should have offered zero support. You should have just blown right through that, right? And continued on your way in the downward directions. The fact that that didn't happen, once again, indicates to me that we have some shorter term buyers in control of this market, and also paired with not really stronger sellers at the moment who are continuing to pressure things in the downward direction. It seems to me like it's kind of like hands off the mouse for a little bit, and short-term traders, momentum traders, are more so in control of the market. If we look at where value is on that session, certainly higher, overlapping with the prior day. So that's kind of impressive. A stronger down market would have not allowed the value area to overlap. You would have seen value underneath this area somewhere. It just didn't happen. So one of the easiest things to continue watching for early on this upcoming week is the new string of single prints that we have here in C period. If we start to take out something like 65.86 right around in here, if we take that out and spend more time in what could be considered the lower distribution of the Thursday session, then that's just more bearish. And honestly, this is now overhead supply. Short-term traders who are trapped in there, short-term traders, they likely close out and you've got nothing. I mean, look at the volume support through here. There's nothing, right? So overhead supply is back and forth. And, this is the same idea, just with a different visual. It helps us give confluence, honestly, with the way that the value area is stacked there to the same exact breakdown. If I just go back over here to the platform, it's the same breakdown as this, right? So the volume actually supports the same thesis. Trapped overhead supply is just hurt underneath 653. Really, 651.75 is the level that we would use as the bottom end of that little orange zone in there. So that's your deep dive through the S&P 500. Let's take a look over at the QQQ NASDAQ 100 and see what's going on from this perspective. We'll do the same top-down approach starting on a monthly. Let's quickly hit this. Let's get those corporate actions out of there. It's just ugly. Then let's do this. We actually want the non-dailies. Let's go here and let's hit it with a clean drawing set. And let's keep moving along. So what do we have? Same concepts. You could see that lower wick actually printed. It came up shy of the previous left side peak. So just to reinforce the same idea, if we overshoot that area, I would not be frightened by that. I would still be thinking about a monthly high or low, and we do have that unfilled April and May tariff gap from last year that we could start paying attention to. Let's drop this thing down to a weekly chart. Let's see what's going on from this perspective. Identical almost to the S&P 500. You've got yourself a nice solid green-bodied bar, a little bit of a lower wick, a little bit of an upper wick, even less of an upper wick, honestly. But same thing. Look below and fail on the bar-to-bar count. Closing strong back over the weekly 50, back over, or I should say, well, over this previous weekly low, but inside the upper third of the previous week's range. All the same commentary. There's still room for a lower high, as we know, underneath this area here. You're actually closer to that in the QQQ, and as we know, that number is much closer to about 590s, which we'll take a closer look at on the daily timescale. You'd be underneath the weekly 20 SMA, which would still be bearish. If we hit this with a Fibonacci, pulling from the highs down to the lows, your 50% retracement is right at that level, and you did close right at the 38.2. So again, we'll give some credit to the buyers here. A little counter trend move, but it's really nothing more than that. You could also do something that looks like this. This lower wick is still roughly acting as resistance. It's where the rally stalled out into the end of last week around that 586, 585 zone. Let's hit it with the intra-week, or I should just say the weekly, anchored VWAP stack on the NASDAQ. And one thing I will concede here is that your chunk of VWAPs, if you will, that's a technical term, your chunk of VWAPs, are more so aligned with the top end of that range, not the bottom end of the range with the overhead supply like the S&P 500. So if you were to overshoot this, I think you could still get a weekly lower high, but it would start to become a little bit more fuzzy, a little bit more murky, if you will, or to use some Fed speak, as Paulson said last week, the picture is becoming a little bit more foggy. If you were to get some kind of acceptance over that 590 zone, you could still reject the band of VWAPs, but are you perfectly underneath the overhead supply? Maybe not. So I would just keep an open mind to that in the NASDAQ side of the market. Let's hit this thing with the volume profile on the weekly. Better confluence off the sort of lower bound, if you will, of the big volume spike. All the overhead supply, of course, is right at that same level. Nothing really changed about that. Obviously, we have this area as well. And to give you the number down here, the gap zone from, what was this? This ultimately was May. That was May 12th of 2025. We have 501 to about 492. Right around in here. So 501, 492, almost a 10-point gap. That would be your overshoot potential if things get nasty underneath the ideal monthly high or low, right? Let's not talk about that as an outcome for this upcoming week, but generally, if we're going to fall into a protracted bear like what we had in 22, that's the level to watch on the QQQ. Let's go on down to the daily by resetting to this view. Let's hit the Qs, and there we go. First things first, expected move for the week. Here it is in the gray shaded area. The upper bound, 601.19. Notice that that is a move over the bottom end of the overhead supply. It's a move also above the daily 200 SMA, which is confluence with that 595 area as of right now. The lower bound is at 568.77. I know it's tangled up there with another technical level from back over here, but once again, that is 568.77, and that would technically mark a slightly higher low. I'd say similar commentary here on the expected move as to what we had in the S&P 500. The overall trend remains in the downward direction with highs, lower highs but equal, lower highs but equal, lower high, and still potential for a lower high here. We're underneath the 20, the 200, and the 50. Does not seem to me that this is a very compelling, oh my God, everything's fixed and to the moon we go. Strong recovery off of the V-shape in here, but still underneath a lot of overhead supply. Same commentary exists as it relates to the FTD follow-through day. We're looking for 1.5% increase in volume, and that's measured from the previous day's close, not the day's open. As long as we hold some kind of a higher low over this, there's potential that people start arguing for the inverted head and shoulders look. That's fine. Of course, the neckline break, I would need to see some kind of acceptance over the 200, over 595, and then maybe we rotate back up through this range with respect to the weekly resistance we just talked about in the anchored VWAP band. So I'm going to say a VWAP, anchored VWAP there. That band is sort of right up in here towards the top end of that range. Although the risk reward makes decent sense like that, you're sort of churning back through some previous chop and slop with weekly resistance overhead. Might be worth a go. It might be worth at least attempting it if the risk reward is tight enough here, but just manage your expectations if that trade actually fires off. More likely, in my view, I would be open-minded to a look above and fail on the 20, something that does this, and then bearish back below 580.75. You could even extend that a little bit further. Look above and fail on the daily 200, lower high back below 595, retarget this area, major prior low 580.75, and then Brigade bolts continue this in the downward direction. And of course, we would just be setting up a lower high in the trend count overall. Not a big fan of trend lines, but we'll hit the NASDAQ in particular with a couple of them. There's one, and if we take the second, right in there coming from this high. This is your anchor. You sort of right into it into the end of last week. If we break the secondary, the primary might be in play. And once again, that just sets us up for that look above and fail on the 200 to primarily keep the downtrend intact and progression to the downside ultimately. Let's drop in the hourly chart. Let's see what's going on from this perspective over here. Let's hit this with some fib pulls from the low up to the high. 61.8 confluence at the lower edge of the expected move. Not overly worried about that one as of right now. Let's hit it from the tradable range on Tuesday into the end of the week. That is a little bit more impressive to me here. 61.8 is not Friday, Thursday's low. Same concepts as the S&P, honestly. So if you were to fail this, right, I think that there's your short. Your thin structure retracement is back down through the P-shaped post of the Thursday profile, and then even through this thin structure as well. We will see some single prints on the market profile that are unfilled on the NASDAQ in just a second. If the market's going to be a little bit more constructive, it would require like consolidation up here, maybe a deep pullback that then offers a higher low. Now all of a sudden we start talking about this, right? And then this becomes constructive in the future. Honestly, as mentioned on the S&P 500, probably a first base case would just be a look above and fail on the 200, retarget something like this. If you bounce here, maybe that's where it gets constructive in the future. But base case here would honestly be lower high underneath and then continuation of the overall trend on the higher timeframes, unless the supporting evidence changes in such a material way where it negates this sort of pathing idea, if you will. Intraday anchored view apps, just to offer some confluence and be congruent in the analysis. Let's hit it here. And what do we see? Again, like this is a great spot where just a bunch of resistance, a bunch of overhead, I call them power lines. Overhead power lines are just everywhere, right? It's like you got a ton of stuff to get through before you could really prove much more of a meaningful retracement. To me, like thin structure is always easy to retrace, which is why the downside threat here seems a little bit more tradable in my view. The upside, I would think, needs to be a little bit more constructive. Like you have to build that structure out. You have to prove that buyers are going to churn through all of this prior left side resistance and then actually make the move with some substance. Good confluence out of the peace talks and ceasefire anchored view apps, if you will, early on in the week being at 580.75. If you drop that area, right, your thin structure is game on all the way back down here to the lower edge of the expected move, if not further into the equal low. So I'm still seeing this as a lower high opportunity. I will give credit once again where credit's due. The buyers did a good job of not allowing for a gap fill reversal on the Thursday session. If you're a stronger seller, you just want to see consolidation here and this to end the week. You want to see maybe a gap fill reversal lower high here to end the week, and it just didn't happen. So we'll concede the point. We'll give credit where credit is due, but I just don't see it through the supporting evidence, which let's just go take a look at the NASDAQ side of the market internals. What do we see over here? Better volume inflows. I'll give some credit there. AD line, better. Cumulative build, nothing. And I would really put more emphasis on the cumulative tick here, or just the nature of where the tick was. I mean, that's way more two-sided trade than anything else on that Thursday session, right? If this was domination from the buyers, you want to be up over the zero mark all day because this measures, as mentioned, from a 3-second intervals. The fact that on 3-second intervals, half of the things are up and half of the things are down on a rally that looks like this, that's not new money buying across the exchange level. That's like a couple of people got pinched early on in the session on the news release, and then everything just continued to chop, right? If buyers were really going to lay into it on the bid, why did we not get a better build on the cumulative there? It just didn't happen, right? Again, a little bit of credit here, a little bit of credit here, even though this is a little bit more neutral. I think the volume flows are probably the strongest argument for the bulls as it relates to the NASDAQ side. Let's jump back over here to the platform on market profile and take a peek at what we got relative to the single prints of Tuesday. There we go. So once again, same sort of situation. If you look at both the Monday high and the Tuesday single print lows, you dipped a toe into those singles, immediately rebounded out of them, produced a P-shaped profile. And what does that tell you, right? Short squeeze. Short squeeze, short-term players in control of the market, not longer-term convicted buyers. I would not call this, as Jim Dalton would say, the OTF. The other time frame didn't really step up here. OTF would be a long, drawn-out profile with give and take, A and B period, B and C, C and D, so on and so forth. You'd have this really thin, drawn-out profile, not all this clustering at the highs like what we had on Thursday. So same commentary as the S&P 500. If you want the single print divider, roughly 24,061, 24,060. Yeah, 24,060, right here. If you drop that on the NQ futures, you're really starting to talk about a overhead supply trap, if you will. Sellers probably sell into that, as well as late buyers who thought, oh, this is actually the start of something real, might not have their wishes granted if you start getting that lower high underneath. Stop outs underneath that should apply more downward pressure. Let's jump on back to the platform here, good old Thinkorswim, and let's get this prepared for the Russell. Let's jump this one up. Let's go to the monthly time scale and quickly check in on this. We do know that the Russell has been offering some relative strength recently. So as it relates to relative strength, certainly decent. Over on the RUT, let's grab our studies. There we go. Notice that we were just much further above the monthly 20 SMA. We do have that same little lower wick that's stepping up here, and a monthly close that did maintain the left side peak there. You could see even, not that I would analyze this as an April bar yet, but the lower wick of April so far is perfect support off that left side peak as well. The trend remains up, and as of now, I'm still sort of looking at the Russell. Let me go out to... Yeah, I guess this actually is the monthly, so that's fine. I'm still looking at this as an attempt to be a successful breakout this time around versus what we had back here, unsuccessful breakout attempt of a multi-year consolidation, right? The Russell really did nothing for a very long time here. This is a multi-year consolidation break. As long as we could Brigade bolt above this area, then yeah, Russell maybe still has some legs behind it. Now, the fundamental story doesn't really add up. As we're thinking about interest rates possibly remaining elevated for longer with what's going on in crude, with what happened with the labor report this morning. But, for now, price is what pays, and we are staying above the top of the box. So that's all set. Let's take a look at the weekly chart. See what we can glean from this perspective. Much better look here, closing at the highs of multiple prior weeks, not just the single prior week. We're also much closer to the weekly 20 SMA in orange there. And we're also not even close to closing anywhere below, never mind even testing the weekly 50 SMA in blue. Now, the threat that everybody's likely to see is like, hey, what if we get a lower high here? It's head and shoulders. Absolutely. We'll talk about that when and if it's relevant, but you probably need to set the lower high first, reattempt the neckline, and then you have a failed breakout on the monthly, which would be of, the utmost concern. So I would start using the weekly 50 SMA as a goalpost for the IWM on the higher time frames. As long as we're above that, bullish. If we're below that, some, much stronger concerns start to emerge here on smalls. And of course, if you're looking for the lower high, you really just want to see a rejection of the overhead supply, which is in there around roughly that 256, 257. Let's drop this thing down. Let's hit it with the fibs. Why not? Let's be congruent. Let's come in from that April low up to this high. Right, we could still see the same ideas. Fib 38.2 is in this rough neighborhood. That makes sense. Let's come in from the top to the bottom. We could see we're underneath the Fib 38.2, so that's technically bear flag consolidation still in the short term. And of course, we'll jump in there with the IWM anchored VWAPs. We do have that set still barreling down on price, offering great confluence for that lower high argument. So, if you think about the fundamental reason for rates to remain elevated, you would probably just want to continue to monitor crude, of course, but it's not, it doesn't add up with the relative strength that I'm seeing in small caps here, which is it's hard to make ends meet on that one, if you will, or there's probably some better analogy that I could use there, but you get the point. Let's drop this thing down to a daily chart. Let's take a look at the IWM, and let's get a little bit more granular here about smalls. So a couple of things to point out. Remember that the overnight low on this open, this is, the Sunday overnight low that was like war week 2, is actually down here at an equal low, treating this as a balance range. The market never actually, in smalls at least, never actually went out to a substantial new low underneath this 239. I would take that as a, pretty substantial data point. Same thing with the daily 200. You closed a singular candle underneath that, and ever since have been straight back above. You reclaimed the 20 SMA on the Friday close, so it doesn't make sense to be as bearish in small caps as it does to be over in the S&P 500, for example. So got to give some credit where credit is due. I would be open-minded to, does this act as a higher low? Is this starting to build a little bit of a rounded base with a flat top, something that looks like this, build out a little bit more right side? Does the market look like that? It's possible. Thin structure retracement back up to this 258, that would certainly put the pressure on for an S&P 500 counter trend to continue in the upward direction. So it's very possible that the way the pieces of the puzzle fit together over the next couple of weeks here, or even days for that matter, could be a breakout in small caps pressuring S&P 500 higher if there's any sort of easing of rates. And this is like a very optimistic take. Please let me be very clear about that, right? This is an optimistic take. If there's improvements with oil, if there's improvements with Fed commentary and whatnot, this week we get some inflation data towards the end of the week, right? If we get improvements there, then you could have this be the fuel for your counter trend to continue in the S&P 500. When you get here, if this rotates back lower, I would start to, again, think about this like a multi-piece puzzle and say, all right, if small caps have done their work and they're starting to roll off for a lower high, does it just mean we resume the primary trend, we'll say PT, primary trend in the S&P 500, which of course is down? Right? That's kind of one of the ways I would use this into the coming week's worth of trade. If we're just sideways in here, let it build out some right-hand side. That's fine. And we'll stay, or at least I'd try to stay a little bit more objectively neutral inside of this balance range here. Let's drop it down to the hourly chart. Not much to really talk about on the hourly that we haven't already covered. Same concepts as basically everything else. Consolidation here with Brigade bolt above opens the door to the 50. Honestly, this chart looks almost identical to Apple. If you know your charts right now, this is pretty much spot on with Apple, right? Let's just go there, actually. Take a look at that, right? Almost one and the same. Apple didn't make a big major low. You can see this consolidation here, flat top. So we'll get into Apple in just a moment. But anyways, Apple is the new small cap. Anyhow, you get the picture. If we get this kind of Brigade bolt there, we'll look at the 50. If we do just start to take out this 249.30, I would be, open-minded to the thin structure retracement. This is probably a trade, but then some sort of a bounce, right, to just keep going sideways in here would make decent sense to me. This is where trend traders go to get chopped up and destroyed, so just probably stay away from that if you're a trend trader, unless you're trying to buy the lows or sell the highs as a mean reversion, like this, or something that looks like that, right? And again, this is probably a trade, but I would be very cautious about overstaying your welcome underneath that 249.30 with the relative strength that this has had. Let's jump in here with the intraday anchored VWAPs. You can see a majority of the stack is actually underneath us versus above us, right? So that's another compelling reason to say, okay, there's obviously some relative strength over in small caps. This is the all-time high anchored VWAP, by the way. If you're curious about that dotted, it's really triangles, upward pointing anchored VWAP. Let's jump on into our, we don't need the fibs on that range, right? It's really range high, range low. Let's jump into the market internals. You did actually hit better volume flows on the Russell side. Okay here on the advanced decline line. I wouldn't write home about it. A little bit better as it relates to the cumulative build. You really would have liked to see a stronger print up towards 2K on this, but credit where credit is due. It's certainly better than the other two indices as of right now. Not out of the woods though, as it relates to the labor data that was released early this morning at 8:30. Quick pop to the upside, only to retrace 100%. If you fail the overhead supply, again, this could lead to a thin structure retracement, but as we know, you're probably just approaching a range low on the Russell rather than actually continuing the trend in the downward direction versus, S&P and NASDAQ. Let's go on over here, take a look at the market profile. For the Russell side of things, what do we have? Same concepts. I won't belabor the point. Thin structure, P-shaped profile, overhead supply in the value area. Not much else you really need to know. If you want to use the reference point in here, I'd say about 25. What is that? 25.21, 25.22. Really the low of the Wednesday session. If you take that out, kiss goodbye the thin structure, and then reevaluate when and if we approach the bottom end of the major range, right? That is it on Russell small caps. Let's get back on over to the platform. Let's take a look through our S&P sectors. Let's get into the back half, the fun half of the video, in my view, where we could start to really put the pieces of the puzzle together in terms of what's leading. Is it risk on? Is it risk off? Is this a fake out? Let's see. So as it relates to the sector posture this week, Mag 7 actually led up 3.92%, followed by SMH Semiconductors and then XLK Technology. Seems like pretty risk on and bullish heavyweight sectors, right? As we look to the bottom of the barrel, it's energy down 6.15%, XLP down about 0.02%, and then the next laggard, it's technically green, is utilities there, about 37 basis points. Now, again, I don't know about you, but this is much more defensive and risk off. This is much more risk on and bullish, right? So the posture at face value actually looks pretty good here. If we jump into some of these charts, though, there's one that stands out to me as being a clear, hey, watch out for that. That's a threat in terms of being bullish. Everything else, though, is about status quo, as I mentioned in the intro. So here's the Mag 7. Is this the special chart saying, hey, watch out? No. This is just a clear opportunity for a lower high underneath the 20 SMA, underneath the breakdown point at 60. Counter trend move in the context of a very well-developed downtrend, not proving it here in the Mag 7. SMH, we didn't really have to wait that long before we found the one chart that is a potential threat to the bear case, right? And we talked about this on Tuesday. Very impressive recovery of the neckline after the extremely weak close on Monday, right? Really heavy close, dead on the lows of that move, to then not offer some resistance on the neckline retest and to continue the rally on that Thursday session and not reject the overhead supply here after gapping underneath it. This is the chart that you must watch if you are looking for threats to the bear case. If you're bearish, if you lean slightly more bearish like I do, please give the SMH the respect it deserves. The market rally over the last, 2, 3, 4 years has been on the sort of understanding that semiconductors and artificial intelligence are going to change the trajectory of not just technology, but therefore productivity and how humans do work and produce things, right? So to ignore this chart as it starts to reclaim here as the leading chart theme group sector over the last couple of years would just be totally irresponsible. So please, for every single troll that exists in the comment section saying, this is the low and it's stupid bear and this, that, like, just understand I'm using the SMH as a huge piece of the narrative if I'm going to have to change my tone about this market. Please understand that, right? And for everybody who actually makes it here, well, congrats. You kind of know my feelings about this. Very impressed with the action on Thursday. Semiconductors retaking the daily 20, a spitting distance from the 50, never interacted with the 200, and the head and shoulders is completely recovered, right? You're already back up here towards that right shoulder. Is there still room for a technical lower high? Yeah, if you want to split hairs with me, of course. But the best lower high would have been underneath the overhead supply. The best lower high would have been under the neckline after breaking in here, and that just didn't happen. So we have to give the buyers respect as it relates to semiconductors. And also, it doesn't have to be NVIDIA. It does not have to be AMD, although AMD looks better. It doesn't have to be those two big names. It can be new kids on the block for semiconductors that continue to fuel the rally in the upward direction. Marvel is one of those names. Marvel is a new leader, I would say, in the semiconductor space, right? And you know, let's think about, you know, what's going on here. It was just a horrible, horrible laggard as this was shaping up. Their earnings projections as of their last announcement were actually pretty good. Gap and Go held against the falling and deteriorating market. Look at how quickly this alleviated back to new highs over this left side peak as soon as the market found a little bit of a footing there on the gap up session from Wednesday and then Thursday's follow through. It's a gap down, but certainly we moved higher, right? Marvel could be a new kid on the block. ARM could be a new kid on the block. These guys unveiled their new AI chip, or, you know, it was either a new AI chip or they're going to start selling that more meaningfully than this, just their other designs, adding about $15 billion in revenue. We wrote about this in last weekend's newsletter update, right? So it's going to be new kids on the block that possibly start to fuel this. ARM, another one, big move higher, higher low against the broad market's lower low, and now just consolidating, I would say, okay. It's not really the tightest looking chart, but it's okay over the 200 on the reclaim. So it could be new kids over in the SMH. It doesn't have to be old granddad now, which of course is NVIDIA. Not to say that NVIDIA is not important. It's still the heaviest weight company in the market, but you know, look for new leadership out of the semis. Let's go on over the XLK. Let's see what's going on over here. Still have overhead supply just like the QQQ basically. This is a mirror image, 5220, still underneath all of them. And for now, you know, as long as we look something like that, I would not be jumping for joy. If we do this and can stage a higher low, great. Maybe you've got some sort of inverted head and shoulders there, but we're just not there yet. XLC, we're not there yet, right? This will be the theme through a majority of the rest of the sectors. Still a lower high attempt underneath these prior areas of support. Let's jump into software. Maybe a little bit of a double bottom happening here, but you know, still just clear as day for the potential of a lower high. Again, I'm not a big fan of trend lines, but let's just strike one anyways. Look at that. Early on in the week, if you reject 8265, pretty tough look for software. Real estate, pretty impressed with the bounce off the low end of the range. This has done absolutely nothing for the broad market over the last couple of months. So just a reminder, SPY, real estate, it literally weighs about 2% for the market. Am I overly worried about what real estate's doing in the midpoint of the range? Absolutely not. I'm more worried about the wealth effect here. So just to see this holding up, that's probably better as it relates to the wealth effect. People feel like their home values aren't plunging, falling, you know, off of a cliff. Hey, we could still go out and buy stuff. You know, we're not worried about, you know, if we got to sell the house, then we're going to be left underwater on it. You know, I'm sure some buyers who bought at the absolutely worst point, maybe they are, but for the most part, wealth effects sustained here on real estate. Financials, another one that's pretty tough here. To me, still lower high threats down below. And we have earnings season upcoming, not this week, but the week after that for big banks. We'll see if that can change the tone here. I would give a little bit of credit if we could sustain and actually break to a slightly higher high. In the short term, this could be what alleviates some of the pressure in the S&P 500, but generally it's still not out of the woods. I mean, this is just a developed downtrend. You could get like daily reversal here, but weekly lower high here and continuation. You're sort of in the peak of earnings season, as and if the timing is going to align there for rejection of all of this overhead supply, right? So just not all that jazzed up about XLF. Let's jump on over to industrials. I'd give a little bit of credit here, some potential for a higher low, and then we go inverted head and shoulders holding on a test of the daily 200. This is a slightly heavier weight sector for the market. You can see here about 9%. I think I've been quoted as saying 8%, but there's 9% of the S&P 500. So we'll give a little bit of credit if you could stage that higher low and keep prices elevated. If this just rolls completely, I mean, look at the upper wicks. Not a ton of confidence there, but if this rolls completely and we're just back at the 200, I would expect that to break and lower. Obviously just downward pressure for the S&P. XLB, oh my God, look, we actually made a higher high. Well, unfortunately, I love using this tab here. Look at materials. About 1.68% of the S&P 500. So you could jump for joy if you'd like and say, oh my God, the market's got to go make new all-time highs. Look at this inverted head and shoulders. But I think you're missing the point of the whole market cap weighted index, right? It doesn't look good in the heavyweight stuff other than SMH. And it might look good in some of the really, really lightweight stuff here, like the XLB. So you have more of a potential for trend reversal. I would honestly start even thinking that this is trend reversal via the higher high there. Not in love with the inverted hammers on Friday, but let's not burn too much brain power on this. Even if you do that, it's not going to save the market. If you do this, then it's just going to continue to act as a headwind. Let's go to the XLV, which is definitely more heavy weighted. This is just classic lower high stuff right off the 20. You tried for a little bit of an hourly double bottom there. I would say daily bear flag failed. Lower high though up against the 20, and this just kisses this thing goodbye. Pretty tough look. As long as you're underneath 150.25, remember that on the weekly chart, this is a failed cup with handle consolidation. So as long as you're below that, this is that wick from there, prior left side peak. If you're below 150.25, sayonara. This is an exaggeration on the drawing for this upcoming week, but you get the point. It's still bearish underneath that level. Let's go on over to the XLY. Let's get off this weekly chart, though, back to a daily. And what do we see here? Just a very controlled, orderly downtrend, right? There's no capitulation on this chart. There's no volume bump. There's no nothing. This is just a controlled and orderly downtrend thanks to Amazon and thanks to Tesla. So to me, just looks weak, rejecting the 20, weak on Thursday, closing underneath Wednesday's low. These, again, the shortened weeks throwing me off, but you get the idea. It just doesn't look good at all. Looks horrible. So in my view, still a downtrend, no signs of a trend reversal there. Let's go to utilities. Technically had a, not a horrible week, but structurally, it's just lightweight. It's also defensive. If you go back over here to the Analyze tab, where's utilities? 2.5% of the S&P. I mean, you should be able to tell by now. These are the sectors that we care about and spend the most time talking about, and everything else, it helps us understand where the risk on, risk off rotation is taking shape, but this isn't going to do anything to actually save the day in the market, right? So utilities, nice rally over 46, but not enough for me to really change my tone. Energy, it's certainly improved. Energy used to be much, much less in terms of weight. Where is it these days? Energy at about 3.83% on the XLE here. Usually it's 2% or less. Nonetheless, no pun intended, pulling back. And I think well-deserved. This isn't going to move in a straight line forever. So energy, as we know, and by the way, commodities, the CL here, and we'll talk CL in just a second, is best bought up against ascending moving averages. So if anything, this pullback would be one that you're starting to look for buying opportunities in oil and gas names rather than, a full-blown trend reversal, especially if you're a believer that things are only going to get worse and or more expensive in the crude market, right? So all the good things can be said in the world about crude and whatnot, but look at where we actually landed as of the, settlement price there on, let's go over here. Let's go to a hourly chart. We just hit tabs like that. Look at where we actually settled. I mean, this is not at all a good look for crude. It's making new higher highs as of the speech from the 9 p.m. session on, Wednesday night, which caused the Thursday gap down in the market. So crude looks poised to go higher. This looks to me more like a successful break in the upward direction. We can continue to check in on BZ, which is Brent. Brent, same thing, consolidation over the 20. Let's go down to the intra-day chart here. Not as much of a rally for the Thursday gap down, but still well above. And this is also, I just realized I hate this. Hate that it always does this. Adjust for contract changes. There we go. This is still elevated over prior left side ceasefire conversation. So, although we're getting conversations from Iran and Oman to potentially figure out something with the Strait of Hormuz, I mean, you're just structurally higher here in crude for the foreseeable future, right? So it wouldn't be unreasonable that I'm not to play geopolitical or even energy expert here, but the fact that Iran is talking about tolling ships through the Strait of Hormuz, the fact that they've been, threatening strikes on shit, your insurance premium on tankers going through the strait is probably just going to be higher for the foreseeable future, right? You're probably not going back to lower prices. So like, what does that mean for the premium priced into crude? You might get some retracement here, but you're probably not going back down. Let me just go back to CL, which I think people, at least in the US, are a little bit more familiar with. It's like 90% of the audience. You're probably not going down here to like $60 a barrel. You could maybe find a floor here at 85, the lows of this area, but it's not like you're just going to wake up one day, the war is going to be over, the strait's going to be open again, and you're here. I think crude is now going to have some kind of a floor, maybe, north of $80 a barrel. So something to be thinking about. What does it do for inflation? Well, we're going to find out in the very near term with inflation data coming out as soon as Friday with CPI. So let's keep moving, though, through the sectors, and let's get the job done here before we continue along with the analysis. Bear flag out of the XLP. This is defensive anyways. Looks like a bear flag sitting on the 200, kind of asking for another leg lower through this thin structure. If it can hold and go counter trend, still lower high opportunities here on the weekly. It's a lightweight sector. It's a risk off sector. So not even, if this does happen here, I wouldn't be jumping for joy and saying, oh my goodness, market's saved. Not really the situation I would be thinking about. All right, that's XLP. Let's jump on into our sector ratios. This will be a little bit of a nicer look at where am I going? Here we are at the risk on, risk off. Give a little bit of credit here. One thing I will say is that the XLK ratio didn't actually make a new low. It started to move back down aggressively, right? Which to me was risk off, and it still technically is with room for a lower high, but I'd go a little bit more neutral than full-blown bear on that one. This is still problematic in financials, which has earnings season upcoming. This is a little bit more neutral on communications. This is an outright bearish look on XLY discretionary. This still looks defensive to me, as does this down here. If we go take a look at the specialized ratio, let's get into the ASAT first. Big counter trend, but for what? Lower high attempt still. Big counter trend, but for what? Lower high attempt here. Still inside of bearish consolidation below the 50 SMA. We'll give a little bit of credit here to semiconductors versus healthcare, and notably so because of what we talked about already in SMH. ARK-K, Cathy over here did not make an equal or lower low, but still well below a declining 50 SMA. Same thing, growth versus value over in the Russell 1000. Not really looking like a full-blown bullish risk on look here. Could we be, starting to look for a turn? Yes, I'd need to see material improvement here as well as over here, right? This is apples to apples, in my view, discretionary versus staples. Let's get on into the B set. Ideally, this would continue to step up and make higher highs. Bitcoin would ideally make a turn as well. Bitcoin sort of stalling out, going a little bit more sideways than anything else in here. And you still are underneath the 50 SMA and the SPY TLT ratio. Risk appetite just not fully back on board here. Let's jump on into the dollar and rates, which is going to be a pretty big narrative into the early stages of this week, later stages of this week with the inflation data. It would have been probably a big deal today should the markets have been open for Good Friday on the labor report. But if the dollar breaks out here on the prospect of higher for longer out of rates because the labor market saved, or labor market saved, or inflation is just hot, right, elevated, then you're probably talking about pressure on equities and financial conditions continue to tighten, right? One of the charts that we've not brought up in a very long time, and I hope it's even still in here, fin conditions, there we go. Financial conditions are upticking, right? Excuse me, let me just go to, maybe not a daily chart, but let's just try. What am I going to get here? This is Fred data imported into Thinkorswim. There we go. This does enough of a job, right? You can kind of see that financial conditions have seen an uptick. And then if I just go down here, SPX, let me just clear the drawing set real quick. And we're on weeklies. Now this is a monthly. Let's go to a weekly. Let's make the same zoom. It might already be. Same zoom. Perfect. So as this starts to tick higher, right, markets start to tick lower. As this starts to tick higher, markets start to tick lower. So financial conditions tightening based on the prospect of a stronger dollar. Let's just go back over here. Dollar and rates certainly play a contributing factor there to the NFCI. So a breakout would be more downward pressure for equities. I think, it's fairly straightforward, but there it is in the actual visual as of the data, right? Let's go on over to, let's take a look at gold real quick. I think gold could possibly be a little bit more of a long if the dollar eases, but a stronger dollar is just going to put more pressure to the downside here. I would just use this 46.50 area. I thought it was maybe set up for a short. The gap down overnight, you kind of needed to do it with futures. If you were going to do it there, it was pretty tough to trade the gap down on the Thursday session. Anyways, that's gold. Let's jump on into, from there, the inverted ZT, which is back to the rate conversation. This is just still higher for longer out of the Fed, which is, of course, the same conversation. Let's just go back over here. Hit the Fed watch tool. We've been talking about this for ever since the Fed, really. No rate cuts for the foreseeable future. You're talking about late 2027 for the first prospect of rate cuts, which, as we know, is based on the idea that the inflation forecasts are upticking, and the labor data, as of at least this morning, certainly a huge beat. So let's just talk about that for a second. If we were expecting 65K, and we know the revision from the Fed is automatically shave off 60,000, this is not bad. This is 110 positive. This was revised down. Remember, it was prior negative 92. So, what gives here? What's the actual between these two data points? I guess we'll ultimately find out. What I do find pretty compelling, or it's not even compelling, but it's reinforcing. We've been talking about week over week over week, every Thursday when the jobless claims come out, that the unemployment rate probably shouldn't be ticking higher. It's a low higher environment, right? And that seems to be reflected here in the unemployment rate, actually seeing a downtick to about a 4.3. So not really that bad there. And so once again, if the labor market's going to remain strong, what does that leave us with? This threat of crude oil providing upward pressure on inflation. Let's go to this upcoming week. ISM Services PMI is going to be the first big tell of that. And then as we scroll down, FOMC meeting minutes might be interesting there to see if there's anything said behind closed doors between Fed members. But PCE, this is delayed. So not as much of an impact there, but this is what I think everybody's going to care about, which is CPI on Friday of next week. So a week from today, I'm recording this on the Friday session rather than Saturday. You could see also preliminary University of Michigan consumer sentiment and inflation expectations. Markets always respond to that more than the revision. So that's what we've got on the economic calendar upcoming. Let's take a look at the earnings calendar. Again, we're sort of in no man's land as it relates to earnings season right now. Let's get through this week, and then the following week will then become the more interesting watch as it relates to, of course, all the big major banks in the market. Let's jump on over to the platform. Let's finish this thing up on a strong note. Let's see what's going on over here with the bond impulse. Is this aligning with inflation being a problem? Well, as of right now, it made a sharp move in the upward direction here, but it's actually not breaking out further. So I would be very curious to see where this inflation print lands on Friday upcoming, as well as the inflation expectations. If expectations remain somewhat, capped here, and Jerome Powell has done a good enough job of suggesting that crude oil is not going to ripple through and it's just going to be a one-time price shock, and we're not going to become entrenched in inflation. Kind of the bond market, believe it or not, on the long end of the curve, like the ratio there is kind of agreeing with that as of right now. So we shall see. Let's jump on into from the bond market over to credit spreads. There we go. They are easing a little bit, and I got to give credit where credit is due. We've been striking this trend line in here. We're right at it on the SHY-HYG credit spread proxy. Remember, it's not exact, but it's a proxy. If this can break the trend line, that would be a bullish data point. If it just bounces off the trend line and heads higher, financial conditions continue to tighten, I would be bearish on the S&P 500. So steps in the right direction, but not all the way there yet. This longer term one, it's starting to make that lower high. We'll see if it ultimately follows through. It's going over here to junk bonds in isolation. They called a little bit of a bull divergence off the low here. You can see boom and boom, boom and boom. Did move higher on the S&P, but now as of right now into the close of the week, a little bit more status quo on. Just no divergence. They're in confluence, I guess I should say. At a loss for words here. Let's go on over to total breadth. Let's take these panes one by one. That way we can actually see the new highs versus lows. Remaining negative down here. A little bit of a counter trend, still well below the 50% marks on both the moving average charts. Let's jump on into the RSP. A little bit of an improved look over here, noting that we did sort of get into this area, but we rejected it for a weak close below. That would have been roughly around, 193.50s. So if we can close above that and start working our way here with improvement in the other indications as it relates to breadth, then I might change my tone slightly early on a breadth, really like a big breadth thrust or something like that, but still in a downtrend clearly after kind of breaking underneath these lows. Let's jump into the QQQE equal weight NASDAQ. Same commentary. I mean, you're even further disjointed from this overhead supply here than the weighted index itself. So not out of the woods as it relates to a breadth thrust in the NASDAQ side of the market. Let's finish up with a look through volatility on the extended cut here. Volatility got sort of hit hard into the end of the week, and rightfully so. I mean, the market rallied quite a bit there, but you're still over trend here on the VIX. You're still north of 2050. It couldn't really sustain a 30 on the VIX, but for now, still not out of the woods on that front. And just down below, I'll hit the VVIX. Why not? And over here, you could see that we've got ourselves, just a small break back below trend. So I'd give credit to the VVIX breaking below 120, breaking below the trend line, but you really need to see the regular VIX start, making that move as well. And then the holy grail of all volatility things in general, there we go, it's going to be our volatility futures curve, which is still in a backwardation here of about 75 basis points. If that could reinvert back to positive, I would be bullish the market. I would start looking for that follow through day. This would certainly be something that supports the bullish narrative and the idea to button up and throw far away the bear case, but we're just not there yet. So once again, I don't want to be any more bearish than I have to be, but these conditions are still what you would associate more so with a downtrending market versus a market that is healthy and ready to make a turn and in a nice solid uptrend, and let's rock and roll and everything's all set, right? So still in the throes of volatility. I'll give a little bit of credit here. This is shorter dated on the 9 versus 30 day versus what we have up here, but nonetheless, still elevated one day. Like, just none of the data points to me are overly enthusiastic about a turn. If we look at skew, this indicator, we've got to turn that off. That is just absolutely brutal. Let's hide that, and let's hide this down here. Where am I going? My goodness. It's so blinding that I can't even see what I'm doing. There we go. Skew did see an uptick, so people are starting to reach for some further out puts. This is 30-day plus skew, of course, so better to see that than the zero DTE phenomenon. And then lastly, we'll take a look. Well, we've got a line chart up at the P call. Get that second L in there. And just note that this is up towards the high. So is it reasonable that the market's making a little bit of a bounce? Yes. Usually when this makes a move up to over 1, you're going to get a little bit of a bounce in the market. So, counter trend in the context still of a downtrend is the idea here, rather than, oh my goodness, this is the low, this is the bottom, it has to turn from here, it's got to be higher. Could it be the low? Yes, it could always be the low. But for me right now, it's a temporary low. It's a low. And in my view, the data points don't really onboard or support the idea that we've got this full-blown reversal. Let's hit the core list of companies quickly and see what we got going on here. I got 12 ideas to rip through after the core list, so let's try to get through it quickly. Still just a counter trend move after attempting a breakdown of the neckline here and the major overhead supply. So I don't think we're out of the woods on NVIDIA. I still think that you could go look above and fail in the 200 again for a short, then rotate to the downside. I think this thing was just priced to perfection. I don't want to be any more bearish than I have to be. I thought it was priced to perfection. It couldn't get higher on 2 knockout earnings reports, and since then has fallen into a downtrend well below, on this lower high at least, below the 50 and the 20, breaking the 200. So can't really get all that jazzed up about NVIDIA right now. If this is going to be a micro inverted head and shoulders, that's fine. 171's your Huckleberry. And then, of course, I'd need to start seeing something like this, primarily here, if I'm going to start changing my tone on NVIDIA personally. That's kind of it. Like, until proven otherwise, I think it's just, lower high attempts. And honestly, go look at something like a CRDO. Here's kind of your head and shoulders on CRDO. Notice how we just kind of like stung that 200 for a number of different impulses before finally breaking in the downward direction. ALAB also comes to mind here. Head and shoulders, stinging this sideways consolidation, boom, tried, lower, trying again, and just kind of lower. So those names, not that they have to act as a perfect roadmap for NVIDIA. Obviously, NVIDIA is a much different company than all of those, but for the most part, I can't quite be fired up to buy NVIDIA right now with what's been going on earnings wise and technical wise. Really, it's just underneath. You're in a downtrend. Objectively, try not to lie to yourself. Right, you're making a series of lower highs. You made equal lows, and you finally blew it out to a lower low. This is objectively just a downtrend. So a lower high would be reasonable in here. Let's jump forward to Apple. This chart we sort of talked about with the IWM. If there's any chart to go higher next week, I would think it's Apple, right? Something that looks like this. That would be a decent little range to trade for, risk reward just like that. Something over 256.10 into 261. Moving along to Microsoft, what do we have over here? Maybe a little bit of a temporary low, but I still think that the idea would be, if you get here, please reevaluate for look above and fail on the 20 to just persist the downtrend. Take a look at the hourly chart. Is there any sort of sneaky trade to take in this spot? Not really. If you're going to say double top, then I would want the thin structure retracement. I wouldn't really want to wait for the break of the neckline in there. So 369.75 would be the number to watch. If you're just consolidating here, I'd let the counter trend grind unfold and see what the 20 has for us up towards that 382.25. Moving along to Amazon, let's go back to dailies. Just kind of range bound in here. It's building out a wider range. This even could be considered a range. So some degree of relative strength. I don't like the prospect of trying to buy this into the falling daily 50 at 213. So I wouldn't really be trying to long this until the 50 plays catch up. And that could happen, Monday, Tuesday. And then, let's say Monday, Tuesday, something like this, you have a wick, whatever. If we then break on like Wednesday, that's where I would start thinking about this over the 50, over the 213 confluence. I wouldn't be trying to long into it on the first go around. If we're just chopping around in here, that's exactly what we're doing. We're chopping. I'm not interested. Let's take a look at Google. Got to give some credit here on the attempted recovery of the neckline. Not convinced yet. I still think it's a 20 SMA rejection at 296. You've got a strong counter trend impulse. You've got an unfilled gap below you. If we take a look at the hourly chart, if we get look above and fail, I would like to be short on a lower high sub 296, retargeting the gap close, and then even looking for follow through the thin structure retracement. Google, not that it has to, but it is one of these names that has not had a fall from grace. If this is the start of the major distribution top, I'd like to try to get short against that lower high, and at least risk reward wise, I know what I'm up against, right? So that to me makes a little bit more sense. If it is going to offer relative strength, I wouldn't really trade it into this chop. I would let it get there. I would let it prove the first high or low, and then just look to invert the pattern. And Google on relative strength maybe looks something along those lines, right? So that is the Googler. Let's take a look at Broadcom. Broadcom range, don't really want to get interested on the long side into the moving average chop and slop. You can just see how much of a headache this is offered through this entire range, really. So if anything, look above and fail, and then a failure back below 309, equal lows, and then the semis sort of have new leaders step up. Broadcom may not be one of them. If it's going to recover, you've got to just overpower the moving averages, probably build out something that does this, and then we're constructive here for that overhead gap close on earnings. Maybe. I mean, a lot of work if that's going to shape up. So I don't want to remain more pessimistic than I have to, but for now, underneath the moving average stack, not really in a clean uptrend. Why would we believe that this is going to be any different than this, which just led to ultimately lower prices, right? So in my view, not too interested in Broadcom in between 309 and 336.50. Let's take a look at Meta. Meta, nice rejection of this overhead gap here. I'd be curious to see if this could build out a little bit sideways, overhead supply, and then make the move underneath 572. For me, I'm almost more interested in getting more buyers, sort of, as I've been saying, jazzed up about buying this thing in here. Hey, look, cup and handle, it's going to reverse, it's got to go to the moon. If you can't do that on Meta, these buyers get disappointed. Some sort of a double top, descending triangle on the hourly, something that looks like this would certainly be, in my view, compelling at least to go back down and target this gap close. I don't think Meta is going to fall off the face of the earth forever. If we just go, let's go back to this daily and let's go to the weekly here. I don't think it's going to fall off the face of the earth forever, but this is some pretty major overhead supply that we're reaching into, right? This is a big, big break, lower high on the weekly, continuation in the downward direction, right? Again, not zero. We're not talking about zero on Meta, but for a lower high, I think the structure makes sense around that 590. Let's go back to a daily chart. Let's keep moving. Let's take a look at Tesla. Tesla, to me, still in a downtrend. No real arguing with that. You've got your unfilled gap. I mean, just nothing to me. There's honestly not much to really do here. The chart's very loose and sloppy. It's not really offering solid entries. One thing that I would point out is that it just has notable relative weakness. I mean, remember what the Thursday session in the broad market did? It was a straight green day, right? A little bit of an upper wick there as we balanced off towards the end of the day. But I mean, for the most part, this is completely the contrary of Tesla, of the market. So relative weakness over here. And as long as you're under 366, I just have to continue looking for downward pressure. If we get above that, it could be gap fill reversal off of the Wednesday low. It could be a 20 SMA, look above and fail to keep the pressure on. I just don't really see the way into a long here on Tesla right now, considering that we've been in a downtrend for a while. Let's go on over to JP Morgan, earnings not this week, but next. And for now, I'd give a little bit of credit getting out of this lower range. Not enough to really change the dominant tone here, but it's a step in the right direction. Again, I don't want to have to remain bearish more than I have to. If this is in here and can start recovering or making some reasonable series of higher lows and then hold it, most importantly, right, through earnings, then maybe there's a turnaround in financials. But for now, hard pressed to just be all in, load the boat JPM on this higher low over the 20, still rejecting the 50, still have all of this overhead supply. I think it's a wait and see until earnings, honestly. Let's go take a look at Palantir. I would be open-minded to a weekly higher low attempt here if this is going to recover and get back over this. Your key is just going to be right there at 149.75. If Palantir cannot get back above 145.75, I would be more so inclined to say your double top is sticking, and instead we should look for equal lows rather than a weekly higher low. If we get back above, great. Your breakout point, let's go back down to the hourly chart here, is getting the recovery back over 156.50. Something in there, right? If we could reclaim that area, you're over the 20, over the 50, and then of course you're starting to look at higher lows being more sustainable, and then boom, you've built out the right side of the base. Left, I wouldn't even go with inverted head and shoulders, but you get the idea. You're building out some new step, a building block, if you will. Left, building block for upper, right? You got to build out that right side here, and then maybe there's some recovery effort in the future. TBD, right? Obviously leaves a lot to be desired. One thing I will say is that this did get bought up, pretty well off the lows on that Thursday session. So impressive response as it relates to the types of buyers getting involved there. It's like there was very little downside that was actually sustained. Speaking of good buyers, look at the, not good buy, but good buyers. We've got ourselves AMD top end of the range here after a gap underneath and into the 204.75 level. So to me, the fact that this is not breaking down, not rejecting the 50, honestly, some strength here, probably better strength than NVIDIA in my view, and the earnings gap above is the next interesting spot. So I don't really want to be a buyer of gap ups or, I don't want to be a chaser of breakouts in a downtrending market environment, but 218.85 is absolutely the number to watch. What this might be is some kind of a break that goes north, and, that's hard pressed to get involved there. But any pullbacks that respect kind of this 218.85 for a higher low, daily higher low setup, great. Something that does this, that's an overshoot on the arrow. 237, the gap close from back here would be the upside target. Let's go on over to Robinhood and see what we've got going on from this perspective. Not much to really say or do here. I would have loved if on the Thursday session we could have extended lower, sold some of those 50 puts down here, even the 60s, but just not happening. The IV rank is not getting perked up, and for now I'm just sort of on the sidelines in Robinhood, not really thinking about getting involved into this chop and slop. So potential for a lower high. We'll see what Bitcoin does. Bitcoin's holding up sideways more so than Robinhood is, but if this can at least make some attempt back into the range, maybe there's some neutrality and it's worth selling the 60 puts and we start to move higher on earnings in the future. It's not offering the best tradable opportunities, in my opinion, on the day-to-day. So Robinhood, we'll see if it ultimately sticks on the core list of companies, but it's certainly fallen from grace. It's no longer a leader. It was a leader back here for sure. Maybe we have to swap that in for a memory name. That could be MU. It could be SanDisk. One of those two might suffice. So with that, let's get into these trade ideas. We're going to rip through them just based on the amount of time we've spent together already today on a Good Friday. Alcoa, AA, inside 3-bar play, bullish on the daily. Any pullbacks over 66. Break through the 2-day equal high, something that looks like this. Bullish aluminum here. We know that there's going to be a supply shock as basically some of the, what would you call it? A foundry, I suppose. Usually I think of steel when I think of foundry, but nonetheless, some of the plants over in Iran who actually produce decent chunks of that, right? Aluminum could see a little bit of that supply shock. So higher there, good recapture, and honestly, one of the prettier charts on the higher time frames for a while now as we've gone sideways. CENX, not an official trade idea because I don't see this as being set up cleanly. You've got yourself more of a look above and fail on Friday, but CENX, the other one, Century Aluminum. Let's go to Circle. As the next major idea, 50 SMA first retest after a pretty pronounced run there. Obviously, the Clarity Act causing some issues on that big downdraft day, but the 50 SMA usually first test, best test, a little bit of a long opportunity here, even if it's just counter trend for a couple of days, might be worth a shot if you could find your way into it early on the Monday session on a break of Thursday's high. Or if you want to look for another look below and fail on the 50, that wouldn't be unreasonable as well. That's Circle 5 below. Take a look at this thing. XLP, consumer staples, up and over this 236 level flat. Kind of interesting, right? Some kind of Brigade bolt there. It broke on earnings in a pretty firm way, but I don't know that, again, I would be a buyer of breakouts in this downtrending market. So look below and fail on the 20, that then maybe, that gets you in, and then you're in there already for the breakout of 236 perhaps. It's an idea. So something to watch out for. 5, along the same lines, not perfect, but fix as well. In here, looking at this breakout point, maybe a look below and fail on the 50 gets you back into the top side of the base, and then anything else is gravy on a true breakout. Hard pressed to be buying breakouts right now, but undeniable relative strength on something like a fix. Let's go on over to INTC, which is Intel. The idea here is a Brigade bolt over 48 could then retarget not only this equal high at 5130s, but probably up here at the local high of 5450, round numbers only. So idea, pull back, probably not chasing the breakout buy here. Look below and fail 48 as a Brigade bolt higher low, and then looking for higher, right? This has started to act as a little bit more of a semiconductor lead, if you will. Let's go MDLN, which is I'm not typing in the box, MDLN, which is a newer IPO and has offered some relative strength as well. It did not blow out to a new low. This is starting to look a little bit double bottom-esque over the high volume close from the IPO date. You've got yourself a daily hammer, potential for a higher low over the 20. I don't know that this is directly actionable immediately, but something that looks like this, back up into not necessarily even that level. We could clear that one, honestly. Let's remove that drawing. You could look to close your gap first at about 46 and then back up into these highs around 50. Maybe not the most unreasonable thing in the world. This is going to drive me crazy if I don't make it round numbers only, so bear with me for 1 second as I do that. There we go, and let's keep moving. That's MDLN. Let's talk about yeah, we'll go to another IPO, which is Q here. Just noting a low cheat setup, right? If this is going to pivot up and over this, if this is going to act as a new leader for the market, if the market's going to find a low, maybe that's interesting. I don't love the upper wicks here, but it's just a chart that I found somewhat, it's been balancing well versus the broad market, I suppose is what I would say here. And if we're going to get this to start to go, that might be it. So that's Q. Let's go back in order I had in the M's, MKSI, which is instrumentation for those who are not aware with all the sectors and groups that these belong to. But so this is for precision as it relates to developing semiconductors, right? And sort of gauges from that perspective. So trendline break here, noting that it did not make a lower low. Yeah, sure, head and shoulders, whatever. But for now, it's in a leading sort of group. I don't even know that I would say group, but it has acted well, let me frame it that way, and potential for longs up and over this, right? So sort of a low cheat there on a daily higher low, weekly higher low, holding the 50, so how do you get involved? Probably takes a little bit of finesse. I'm not saying it's set up perfectly right here, right now, but it's definitely a name that I would kind of have on my radar. And that was kind of the idea of the scans this week, is just a bunch of names to have on the radar. Something that looks like that into highs, something that breaks, pulls back hard, shakes out the 50 again, and then goes to highs. It could be here, and you trade that as a range a little bit. What you don't want to do is you don't want to get involved, on the look below and fail, and then you just continue to hold it as it makes a move to the 200. That's what you want to avoid. Hence the reason for stops, right? This risk reward here is good. If you could get this on a pullback retest back to the highs, right? That's this one here. That looks pretty good. So anyways, MKSI, not bad. MPWR. MPWR. There we go. Monolithic Power. I always think of Manpower Group when I think of that one, but nonetheless, what do we have over here? Same thing, low cheat, right over the 50. So you could do a couple of things up and over and here. And this is probably, you're not really options trading this. You're probably just taking a couple shares at this price point, but you get the idea. Something over 1120 as a low cheat. Is there some way to maintain the daily 50, the daily 20? Again, relative strength to the broad market, not breaking down to a new low over here. Is there some kind of way to get involved? Perhaps. Right? That is that one. Let's go on over. Q was up next alphabetically, but let's jump over that. SATS for EchoStar, a nice rounded base over here, breaking through these highs. How do you get involved? Again, probably takes a little bit of finesse here. You would like to see a pullback against the 50 as it starts to maybe curl higher. You'd like to see it build out some right-hand side, and then maybe there's a setup over here, pre-earnings or something like that. There's a number of ways that the chart could set up, but I just love the sort of rounded base in here, recovery over the moving averages, good day on the Thursday session. It's got relative strength to the market, good linear run in the past. This is even pretty linear over here. If it breaks out, could seriously have some legs behind it. So that's SATS, and then we'll jump on over to SOLS, which is a newer IPO as well. Could have honestly mixed it in with the Q and MDLN analysis. The idea here is just, again, relative strength. Relative strength to the broad market. Wouldn't really say so on Friday, but if this could look below and fail the 50 and the 20 and build out, dare I even say inverted head and shoulders like that, you might just have something in here, back up towards these highs to be tradable, and then watch for continued just basing action, right? Something like this. If the market can pull together and see something more constructive in the NASDAQ back over the 50 SMA and such, maybe you're back over 84s here in short order. I don't love the Thursday bar, but starting to keep an eye on that. SOLS, WULF, WULF, one of the last ones on the list here. It is the last one. Just a huge ascending triangle on the weekly. No, sort of weakness, no drops to new lows. Continuing to hold up quite well, and the short interest is still pretty high. So if WULF can really get going up and over about 17 in here, top end of the range. Again, I don't know that this is set up perfectly as of Thursday, but some kind of like reclaim of the 200, or sorry, not the 200, but the 50 and the 20, then sort of a look below and fail on those levels. We could have something happen here out of WULF if it can continue along its ascending triangle sort of journey as it's been doing so far. Again, use a zoomed out chart here to really indicate the story of what's going on with buyers and sellers. Buyers are making progress. Sellers are making less and less and less progress as all these higher lows stack up. You could see we're knocking on the door of a potential breakout. Unsuccessful breakout 1, 2. Let's see if third time's the charm. Something like that into the near-term future. It's a possibility. So that's what I've got for you in today's extended cut of the weekly watch list. If you enjoyed the video or learned anything new, let me know down below in the comment section or by giving the video a very simple thumbs up. As always, we'll be live Monday morning, 8 a.m. Eastern time for another episode and installation of the pre-market prep, where we'll give you a game plan for the day ahead in terms of the ES futures, NQ futures, SPY, Qs, IWM, Russell, the whole 9 yards. we get it all done. So with that being said, have a great, fantastic long weekend. Markets, of course, closed today on Friday. Hopefully you could spend some time away from the desks this weekend. Have a green weekend, have a green trading week. And as always, I will see you in the next one.